Okay, and welcome back, students who are taking Math for Business and Finance and Math Applications. And we're working on the theory videos for Chapter 16, and we're up to our 9th video, and we're basically working with our ratio analysis, looking at our ratios. So in the last video, we had gone over the current ratio, okay? Now, I have the slide for the current ratio up because the current ratio was simply our current assets over our current liabilities, right? So we have current assets over current liabilities. And I had gone through just some of the more theoretical concepts of where do you find information. You know, it's not always going to look the same on all of the financial statements. I tried to explain what current means, being now to the next 12 months, right? And this has to, the reason why I'm showing you this is because when we look at this next ratio, which is our acid test ratio, or sometimes called our quick ratio, it's very, very similar to the current ratio with an exception, and that exception throws a lot of students off. If you notice here in the formula, I have current assets minus inventory minus prepaid expenses, and that's all over my current liabilities. Okay, so what's the difference between the asset test ratio and the current ratio? Remember, current ratio is current assets over current liabilities. Well, obviously the only difference is this right here, our inventory and our prepaid expenses. We're subtracting the inventory and subtracting our prepaid expenses. Now, let's think about this for a moment, and there's a reason why I'm going over this as usual. I have reasons for what I do. When we were looking at the current ratio, we were talking about current assets over current liabilities. And I had made a point over what is termed current. Current is between now, okay, and the next 12 months. So when you're looking at your balance sheet, you're going to see your assets and you're going to see your liabilities. Okay? And underneath your assets, you're going to have current assets, and under liabilities, you're going to have current liabilities. Under assets, usually you move from current assets to what they call property, plant, and equipment, or just plant and equipment, because those are a lot longer term assets. You can't readily sell off equipment, and you can't readily sell off a building or land, okay? And that's why it's not within 12 months, and they're not considered current assets. And the same thing with liabilities. You know, you have an accounts payable. Well, you can pay that accounts payable within, you're supposed to pay within the next, 30 days if that's the line of credit that you've been extended. But, longer term liabilities such as mortgages, okay, they're going to be underneath the long-term section. Now, that's how we're looking at the current portion of our assets and the current portion of our liabilities. But now when it comes to the quick ratio or the acid test ratio, it says minus the inventory minus the prepaid expenses. And what does that mean? Well, when we're looking at our assets, we had our current assets, and we had our prepaid, my property, plant, and equipment. And when we add all of that up, that became our total assets. But we obviously know that current assets don't make up just one account, neither does our property, plant, and equipment. Our current assets are made up of things like cash. Next thing would be marketable securities, which you're not going to find in this book because that's a little bit more advanced concept. Okay, I mean, when you think about marketable securities, you're talking about stocks. A company buys somebody else's stock. Well, if I want to, we're talking about liquidity here, okay? How quickly can you convert something into cash? And remember from the previous video, I said, our balance sheet, when we were looking at the format of the balance sheet, I had said that the accounts are generally listed in the order of liquidity, from the most liquid, which is cash because it's already cash, to the least liquid, which is probably like land. It's hard to sell land and convert it into cash, really quick. Marketable securities, stock certificate, now is a push of the button to be able to convert it into cash. Then the next thing you might have is your accounts receivable. Well, remember, you're extending people credit for 30 days, right? But, if you needed that cash now, you can call them up and say, hey, you don't have 30 days, I need that cash now. So, they're going to hem and haw, but really you can sometimes convert the accounts receivable into cash a little bit quicker, okay? You don't have to wait the 30 days to get it, right? But you see where, with the marketable securities, it's push of a button and you have cash. And with the accounts receivable, you're waiting for somebody else to pay. And even if you did make the phone call and they said, hey, I'll write you a check, it'll come to you the next day. Okay, so it's relatively liquid, okay, but there still has to be some conversion done. Okay, and then when we move beyond our accounts receivable, we can look at our inventory. Okay. Now remember, your inventory is what you're selling, and usually you're going to turn your inventory over and over and over. Okay, but depending, you're not going to sell off all of your inventory in the next day. Okay, it's going to take time for you to sell your inventory. Okay, and it might take more than 30 days to sell your inventory, but it isn't, you're going to turn that inventory over during the course of a year. Okay, so that's why it falls in the order of sequence for liquidity where it does. Okay, and of course prepaid, then we have prepaid expenses, and your prepaid expenses would be things like your prepaid advertising, your prepaid rent, okay, things that you pay in advance. Like if I'm prepaying my rent for the entire year, let's say my rent is $1,000 a month. Well, I'm sending them a check for $1,000. Okay. Granted, I didn't if I said, like I'm leaving and I want that money back, well, there are legal agreements and things like that that has to be considered, but it's not relatively easy to get that prepaid back quickly. Okay. I mean, you can sell your inventory, I could sell that chair on the next day. I could sell that, whatever, couch, bookcase, automobile, in a relatively short period of time. I might have to wait on that prepaid to come in, all right, because of, your, the legal ramifications of it, the contract of having a lease or prepaid, okay? So that's why it falls where it is. Now, all of these things have a tendency to, when you add them all up, they become your current assets, which is what we have here. And then after, so all of these things make up that current asset. Now, I'm not going to get into the property, plant, and equipment because equipment, buildings, land, that has nothing to do with the asset test ratio or the current ratio. Okay. What has to do with both is that when I'm, like I said, when I'm looking at my current ratio, I'm looking at my current assets, the total of my current assets, and the total of my current liabilities. Well, these here are all my current assets. But now when we want to look at our asset test ratio, our quick ratio, what we want to be able to do is say, what can we turn into cash like almost immediately, okay? And therefore, inventory doesn't turn over that easy. I mean, you have to find a buyer, okay? And that buyer might not come in for, a week, 2 weeks, 3 weeks, a month, okay? And the same thing with my prepaid expenses. You're not going to get that back relatively quickly. These other things here, cash is already cash. Marketable securities are already, like I said, just sell my stock. and I get that money back into the account. And my accounts receivable, it's just a matter of getting that within 30 days, or I might give them a call and have them send me the check, because reality is you were extending them you were extending them the credit. That money is due, and we've become accustomed to this idea of an accounts receivable and being able to pay in 30 days. But the reality is you can call that in at any time. So when we're looking at our asset test ratio, we're no longer looking at strictly our current assets, the total of our current assets. We're subtracting out inventory, and we're subtracting out prepaid expenses. Okay. Now, this is all on a higher level. Okay, let me erase all of this. As I'm talking about this on a high level. Okay, and if you look in the textbook, that's the formula that is presented in the textbook. Current assets minus the inventory minus your prepaid expenses over your current liabilities. But again, right, we have to consider what we're actually looking at. Okay, everything doesn't necessarily fit into a neat package where I could just look in the book and it tells me exactly what it is that I need to be doing. I mean, we were talking about merchandise inventory as an example. Merchandise inventory being, what we sell, okay? But what happens if we don't have merchandise inventory? What if we have, store inventory of some sort, like office supplies, okay? That may or may not be included as part of, your current assets, okay? What if you had a notes receivable, for example, all right? And notice I'm making these things up, I'm thinking about this. You can have a notes receivable, right? Well, what if that notes receivable was a 90-day note? Okay. Well, when you're looking at your balance sheet, you would have your cash, you could have your accounts receivable, you can have your inventory, you'd have your prepaid, and you might have your notes receivable here, okay? Or maybe the notes receivable might be up here, okay? Depending upon the length of the term. Maybe it's not 90 days, maybe it's 120 days, okay? In one circumstance, that would be included under the current ratio, regardless if it's a 30, 60, 90, or 120 days, because it's less than a year. But what if that notes receivable was only a 30-day notes receivable? Okay, well, now that would be included in your asset test ratio, okay, because it's such a short term. But if it was 120 days, then instead of just having inventory and prepaid expenses, you would also have a minus notes receivable, right? So this is just one example, and the whole point I'm trying to make with this is that you can't just copy out of the book, okay? I mean, it does show you the formula, and you see the formula here, but you have to use a little common sense, okay? It all depends upon the circumstance and the situation, all right? And the deciding factor is whether, it can be converted really quick, okay? Inventory can't be converted really quick, okay? I mean, you may be able to sell something tomorrow, but it might take you 2 months to sell something, 3 months, 4 months, okay? So it can't be a quick ratio. And the purpose behind looking at the quick ratio is to be able to say, do I have enough cash? Can I get enough cash in order to pay my current liabilities, all right? How liquid am I, so that, I'm able to operate, properly. If I don't have cash, then I'll be running into issues of having to borrow and then having interest and and additional expenses. But if I'm really liquid in my cash and I'm able to get my hands on cash real quick, I could take advantage of opportunities. I don't have to be borrowing money. I don't have to be paying the additional expense of interest, and that makes my business a little bit more valuable. Okay, so that with this video, I hope you understand the difference between the current ratio and the asset ratio, the quick ratio. Watch the video again, and if you still have any questions, feel free to give us a call. Okay? I'll see you in the next video for the next ratio.